In the name of God, most beneficent and merciful, peace be upon all of you wonderful people. Good morning, good afternoon, and good evening, ladies and gentlemen, wherever you are across the globe. Thank you for making the time to spend with us on this wonderful topic. For those who don't know me, my name is Dr. Ebaad Momin. I am a director at Rever Financial Services and Step Up Ventures and a partner at Mount Rudy Ventures. These are three institutions that are working in the field of alternative finance, which allows value-conscious investors and capital seekers to do so, remaining on their value system. And when I say alternative finance, we work on structures that are within the framework of the value framework which we've laid out, and are within, and very importantly, are within the realms of the Indian legal system. So as a first of the series, we've tried to keep this webinar fairly basic and simple, and encourage you to ask as many questions as you want to. The question and answer tab is available. You can post in your questions at any point in time. For the ease of this, we would take all the questions right at the end after the panel discussion. So jumping right into it, what I would do is I would take you through a few common financial mistakes which people make, all of us make. Some of us make it again and again. Some of us make a little few of them. What are the various financial asset classes? When I say asset classes, I mean, what are the types of investments or the categories of investments which one can make? What is ethical or social responsible investing? I'll just breeze upon that. And why on how should a person plan for life's contingencies or life's plans? And lastly, we'll have a panel discussion with a couple of doyens of the finance space, Mr. Sharif Kotapurat and Mr. Qazi Arif Zaman. So one of the most common mistakes which people make is ignorance and procrastination. Now, people are have generally stayed away from finance for a couple of very simple reasons, right? One is this, that it overwhelms them, one. Or two, because in lines with their values and certain misconceptions, people have actually stayed away from this, saying that, this is not in the part of my value system and I will stay away from this as far as possible. But what we'll try and do is we'll bust this myth, or we will try and demystify to whatever extent which we can here. So investing or finance is just not one concept, right? You can actually break it down, whether it's in terms of budgeting, cash flow planning, savings, and then comes investments. The second big mistake which people make is, and which is very common amongst business people, which I've seen in my limited career of about 15, 17 years, is this, that a lot of businessmen have family assets in the name of the business. So whenever they need, they will take out money from the business and put it for a family need. And whenever they have a business need, they'll take out money from the family corpus and put it into the business. Now, sounds all right, but what really happens is businesses go through cycles. You can't, and if the cycle is bad, and if your son needs money to go and study, you are going to be left helpless. Or if there is a family emergency, you're going to be left helpless. So lack of differentiation between business and family assets is one of the bigger mistakes which people make, especially businessmen. Underestimating life's contingencies. Now, things like, we know that we're going to die someday or the other, but not many of us actually plan. Now, when I'm saying planning for it, means how are you going to create a corpus and how are you going to structure it, right? A lot of us actually plan for it in the sense that we invest some amount of money or buy some real estate or whatever, but there is no structure to it, right? When I say structure to it is, I've seen umpteen number of cases where, families start quarreling amongst each other because they don't know where the papers are, or they don't know what the title is, and so on and so forth. So I'll just go over these over a period of time. lack of tax planning, one of the major financial mistakes. And I say tax planning and not tax evasion, because the idea is no breaking any law, but there are a number of ways where you can reduce your tax incidence and ensure that you still invest properly. And these are four broad areas. The fifth area is, I've highlighted it differently because a lot of us fall into this space, right? And it's a lesser problem, but still needs to be addressed. We do invest in some way or the other, but we invest without a plan, right? The first mistake is over-reliance on one's knowledge. And it's a human tendency, right? Whether it is with respect to finance or whether it is respect to anything else, we think that we know more than a lot of other people. Now, with respect to finance, what really happens is there are a lot of people who pose as, financial advisors per se, and they will come to you and all they do is push products to you, right? So yes, you have to be careful whom you take advice from, but it is a cardinal error where if you're not going to consult other people on what is happening in the finance space, there is a great likelihood that you might go wrong. Investing on emotional grounds, like how many times have we had nieces, nephews, some uncle coming up and saying that this is this is a great investment, come and invest, right? And we've got no clue where the investment is, what it is, and so on and so forth. It's a very fundamental error which goes around, but it is. Herd mentality and fear of missing out. A typical example which I can take here is we operate out of a place called Bangalore, and unfortunately we are infamous for Ponzi schemes, right? And a lot of us hear that, what, my neighbor has made so much amount of money by investing into this asset class or this particular investment. And when you keep hearing these stories, time and again, you tend to go and flock towards that, saying that, we don't want to miss out on this, and we don't want to look like fools in social events. So the problem is we don't understand the risks associated with different investments. And I'll come to I'll dissect each of these risks down. These are not the only risks, but they are one of the few of the majority of them. Not paying enough emphasis to inflation. Now, what is this animal called inflation, right? So today you have 100 rupees in your pocket, and that can buy a certain set of commodities or goods, right? Tomorrow, 1 year down the line, this 100 rupees will not be able to buy the same quantity. And this is because of inflation, or we call it mehengai, as we call it, right? So we don't pay enough emphasis to inflation, and we let our money lie in our savings account or our or our current accounts, just hoarding money, not looking beyond traditional investments. I mean, how many times have I looked at people and asked them, really big people, and they've said that there are only 3 asset classes which they invest into: 1, gold; 2, real estate; and 3rd is their own businesses. Which is significant, which is fine. Real estate has made great returns over a period of a decade or so. But you need to look beyond these traditional investments, because there are much better investments which have come up, or during a particular period of time, they may perform slightly bit better with a lesser risk installed as well. Not taking a portfolio approach. Haven't we heard about not putting your eggs in one basket? Investing is a similar kind of a scenario. You have to take a portfolio approach where the risks associated with one investment, when brought together with another investment, comes, or when they interact with each other, the overall risk of your portfolio comes down, whereas the returns may remain the same. So it is very essential that you diversify your risk in various asset classes and various baskets, right? That's where I was coming from: a risk of diversification, lack of diversification where people don't diversify, and rebalancing. Now, what really happens is, although you may diversify into various asset classes, it's very essential to keep track of these asset classes, what's happening, because the world has become so connected that, when the US sneezes, the Indian stock market goes down, right? So what you need to do is you need to take out certain investments from some place, if it is possible, redeploy it in some other place, and so on and so forth. One thing which is very important is that one size does not fit all. So something which may work for Mr. Kazi may not work for me, because our ages are different. We need money at different points in time of our time, right? So we need to take that into consideration. Lastly, and very importantly, not investigating enough if an investment is consistent with our value system. Now, for people like me, I invest my money in lines with my value system. When I say my value system, it means that I am not going to invest into something which is going to be socially irresponsible. I am not going to go and invest in an arms and ammunition company. I'm not going to invest in an alcohol company or a gambling company. Now, what really happens is there are few people whom we look up to and say that, what, is this compliant with my values? And if the person says so, you blindly follow that. There needs to be a little bit more work going behind that, as to what is the reasoning behind this person or this entity saying that this is a compliant as per your value system. And you have to dig slightly bit deeper to understand this. Now, this may be slightly overwhelming for you in terms of the number of errors which we make, but I've tried to summarize as many as I can. There may be more, but these are a few of the top ones. So what are the financial asset classes which a person can actually invest into? So what I've done is, this is a gauge which I've made, whereby on the left-hand side, there is low risk, low return. And understandably, as you go higher on the risk, you expect a higher return. So right at the lowest risk is precious metals or commodities. I'm saying, I know that I can be pulled up for this, but I really want to bring in, this is physical gold, right? Physical gold is one of the most safest assets you can get, because institutions, countries, sovereign funds, in case of crisis, move to gold, right? And understandably, if it is the lowest risk asset, it's going to give you the lowest yield returns, which means that if you own a bar of gold, you're not going to get anything out of it, just apart from the pleasure of owning that piece of gold. To debt or deposits or bonds, for people who are value neutral, this is fine. For people who are value conscious and did not want to invest into instruments which are interest based, there are options called sukuk across the world. Unfortunately, in India at this particular point of time, you don't have many debt instruments, or rather negligible debt instruments which are compliant as per value system. Real estate is the third most safest asset which you can find. Obviously, this means physical real estate. There are REITs, there are joint ownership platforms and stuff which have come through. And I'm taking this just on the basis of, I'm not categorizing it in any way. There are various risks which you need to look at later on, but on a basis of as is, this is if we were to put it, this is how the risk profile goes. Alternatives are asset-backed investments. One of our companies, Rebel Financial Services, does a lot of these alternative assets, which is a sort of a leasing company, whereby you have a portfolio of assets, and when you invest, the money is asset-backed, which means that in case you would get the revenue proceeds from that particular asset, and in case the person does not pay the lease rentals, the asset is taken from him and given off to somebody else. So the risk is low, but the return is relatively all right. Moving on, equities. Equities means shares of a company. This is just to simply put it, if you buy one share of Reliance, you are one millionth share owner of Reliance. The price of, if the company does well, the price of the share goes up. If the company does badly, the price of the share comes down. But nevertheless, in a normal case scenario, if you look at it a lot longer period of time, equity would generally give you a return of, you should be happy with a return of about 12 to 15 to 12 to 18% kind of a return. Private equity or venture capital is slightly bit more higher on the risk side. And as a venture capitalist, just to explain it in very simple terms, what we as venture capitalists do is we take a seed and we put it in the ground and we nurture that seed. We put in manure, we put in water, and that seed ideally would become a plant, and from a plant it will become a tree. Considering you are right, you are taking the risk of whether the plant will come out from the seed or not. You are entitled to significant returns from when the plant really comes out. Derivative instruments are the highest on the risk because they are leveraged instruments made on all these kind of things. You can have derivatives on commodities, you can have derivatives on debt, you can have derivatives on real estate, alternatives, equities, and so on and so forth. So what does this mean? Very simply, if I buy one share of Reliance, I can invest 100 rupees in this share and say probably I get a 10% return from this. I'm not happy with this 10%, right? I want to make more. So what I do is there are derivative created on it, which means that on my money, if I'm investing in Reliance, I will get 400 rupees more from the bank to be invested in the same asset class, which means that now I can buy 500 rupees worth of Reliance shares, 100 of my own money and 400 of the bank's money. Now, what I have to do is, if I make 10% on the Reliance share as is, I will make 10, 10, 10, 10 on it, right? Because I've got 500 rupees of shares. Now, if I make 10, 10, 10, 10, I have to also give the bank some interest out of it, right? So we'll take away, say, probably 5% from each of these. Now, what happens is then I make 10% on my own money and 5% on every 100 rupees which was borrowed by me and invested in Reliance. So I make 10% plus 5, 15, plus 5, 20, plus 5, 25, and plus 5, 30. Now, this seems to be very good, right, in an upside scenario. But in a downside scenario, you are going to be you're going to even lose the money which you have invested, because the bank would ideally want their money back, and hence they would take away whatever you have. So it's a two-edged sword. And in most situations, derivatives are instruments which are not, not inconsistent with the value or with a lot of people's value systems. Now, these are asset classes which will give you returns from commodities, which would give you almost no returns. Debt, which will give you returns from anywhere about 5% to about 8-ish%. Real estate will give you a rental yield for, residential real estate for about 3-odd%, commercial real estate for about 6-odd%, sometimes even higher. Alternatives will give you anywhere returns from about 8 to 12%, equity from about 12 to 18%, private equity, venture capitalists a lot higher, and derivatives, you can just name it. What you need to do is you need to see where you are. You need to understand the risks associated with whatever investment you are going to make. Right? So what are the risks? One, price movement. So if a Reliance share goes up one day, it will come down the next day, go up, and so on and so forth. Now, are you in a position to be able to lose 10% and still hold on with the hope that it will make another 10%, 15, 20%? That's the risk which you need to understand from price movement. Issuer risk. When a Reliance share is there, the issuer is Reliance. Right? When the government of India gives you a bond, the issuer is the government of India. Now, governments are generally known to be risk-free, and hence anybody who is a private party has to give you a much higher return for you to take the risk, and hence you need to understand what the issuer risk is. So whether it is the government of India which is giving you a paper saying that I owe you money, or is it some Mansoor Khan who's giving you a paper which says I owe you money? So you need to understand the risks associated with this. Regulatory structure. Regulatory structure means, I'll just give you an example of the venture capital fund that we run. We are regulated by SEBI. What does this mean? That everything that we do, right from collecting the money to storing the money to deploying the money to getting back the money, is all overlooked by the Securities Exchange Board of India. All right. Now, what this means is that in most situations, investment schemes which are regulated will be relatively safer than a similar unregulated scheme. That does not mean that an unregulated scheme is bad, right? It may be still be good, but you need to understand that there is a higher risk associated with it. How do you mitigate this risk? You need to understand who are the people behind this particular investment proposition. What have they done before? Are they trustworthy? Are their auditors good? Are they transparent in whatever they're saying? So you can also invest in unregulated schemes, but you have to be aware that you have got no recourse, right? Or you'll have to just stand outside their offices and ask for your money. Liquidity means that how easily can you get your money out, right? So you need to understand whether an asset is, easily, if I present this piece of paper, when I get my money back, or is it going to take me 5 years, 10 years, etc., etc. All of this you need to assess with your life cycle where you are. So if generally younger people tend to take a larger risks, because what really happens is that you have the ability to recover your losses because you're working. But for a person who's retired, you don't have the ability to recover these losses, if at all. So generally, people tend to lean towards lower risk when they age more. Nevertheless, I have seen extremely old people with super risk, and they say that, we've lived our lives. We want to dabble with venture capital, private equity, derivatives, equity, and whatnot. Moving on, what are ethical investments? So ethical investments, as an international body called Social Investment Forum says, it integrates personal values and societal concerns with investment decisions, right? For people like us who invest in lines with their values, which means that we will not invest into anything which is socially irresponsible, right? And a lot of it is got to do with the kind of faith we follow, right? So in a place like India, Jains follow a value system, Christians follow a value system, Hindus follow a value system, Muslims follow a value system. What is your value system and how do you go about your investment is what ethical investments are. There are a lot of agencies which actually stamp your investment as an ethical investment or not, and so on and so forth. Just to give you an understanding, we at Mount Judy Ventures are signatories of the UN Charter of Principles of Responsible Investing. And this is one entity by the UN which basically certifies you as responsible investors.